Hi there, my name is David Andolfatto. I'm with the Federal Reserve Bank of St. Louis in the Research Division. I'm here at the 40th Annual Fall Policy Conference and speaking with Hal Cole of the University of Pennsylvania, who just gave a talk in the conference on a paper that is entitled Analyzing the Effects of Insuring Health Risks, subtitled On the Trade-off Between Short-Run Insurance Benefits versus long-run incentive costs. Thank you very much, Hal, for sitting down and
Pleasure to
talking
be here.
to me about the paper here. Why don't you just get right into it? Tell me what's the basic idea behind this paper? What question are you asking here?
Okay, so first of all, we were kind of interested in to what extent health translates into either income or medical expenditures. So to what extent you face health risks. And we were really primarily concerned during the years between when you start work and you finish work at retirement. And trying to sort of think, is that big, and to what extent those risks are controllable, by your own behavior. There's all this stuff, we all read about it, about the obesity epidemic and various other things, the increased onset of diabetes. And so you're reading that in the background. And truth be told, at the end, a lot of the things we get interested in are motivated by our own life experiences.
Sure.
I have young kids, and I had to deal with doing sports with them, and I found myself back, in the gym working out, thinking I gotta, survive until, pretty late out there. And so I was thinking about how much I was working to try and affect my health, and then the kind of risks and trade-offs that people face, and the extent to which people can or are not incentivized to do something about things.
So your paper is specifically about examining the likely incentive effects of different certain legislations concerning health care.
Yep.
Can you describe what specific legislation you're interested in, and kind of your interest in what potential effects it has on the incentives for people to lead more or less healthy lifestyles, I guess?
Yeah, so one of the things that struck me was, my wife's a labor lawyer, so I learned some things vicariously through her, which is to what extent employers are being forced to basically eat the health-related costs associated with their employees. And I started thinking about to what extent that then feeds back on the incentives of employees to take care of themselves. I started thinking about also in terms of Obamacare. Yes, we're going to be insuring a lot of people against their health-related things, and insurance obviously has big positive benefits. But at the same time, it might be affecting the degree to which they had maybe a fairly from a bleak perspective, but an incentive to be more careful and take care of themselves.
So oftentimes as researchers, when we approach questions, that's been my experience, I'm sure yours as well, as you mentioned the example of your family, we're motivated by things we actually kind of see out there.
Yes,
I mean,
exactly.
To be honest, I don't think it would have struck me as immediately obvious that a change in the healthcare legislation might, I don't think I see, perhaps I haven't been looking hard enough, but do you see examples of how people have modified their behavior in light of being insured in general, or specifically owing to this legislation?
I think in general, do I see specific examples of people? I think in general, at least looking around me, and certainly a lot of it is it's somewhat internal, which is that I certainly see myself responding, as I was suggesting, to the incentives and to the need to go out there and still be able to beat my kids in soccer and various other things. And so I see myself responding, so I assume that others probably to a fair extent will do so as well. But one of the big things we were trying to do was think about, first of all, how would you model these policies? So what's a nice environment in which to model these policies? And then to try and think a bit about how would you take such a model to data. And a number of things came out of that I thought were interesting. Is in modeling the policies, for example, take we have a stylized version of Obamacare where we're going to try and in the data we have data on health status, And so we're going to treat that as your pre-existing condition, in the sense of if you have excellent health, that's your pre-existing condition. If you have the lowest, which is fair health, which is actually poor, that would be your pre-existing condition. And then the question is, what kind of program would you have to put in place to sort of prevent an insurance company from trying to price discriminate across the various groups? And what impressed us was the extent to which you had to intervene, and you could see that in the model, which is the extent to which you had to try and stop these guys from trying to use, for example, the way they structured the benefits, what we would pay for, to try and prevent you from cherry picking.
Give me an example of that. For example.
Well, let's think about the price expenditure trade-off. If you have someone who has very low risks of some of these things, then if I take that out of the mix, that's not going to bother them very much. Where if you have someone else who thinks they face fairly much higher risk of those kinds of expenditures, then you
like
might
young
take
versus old, for
young versus old. But also the idea is people report things about their health status, and so they come in reporting in the surveys that we use. And what you find is they're fairly predictive, in the sense that people who report, good health status or excellent health status have significantly lower, medical expenditures during that ensuing 6 years than people who report, poor or fair.
Do you have in your data measures of how much time people allocate to maintaining their health? Because that's a critical.
Right.
That's a critical.
So what we have is there's one panel data set called the PSID. And that follows people, and we have a bunch of data in there, but in terms of effort-related stuff, we have 2 measures of exercise, light and heavy. And light covers things like even housework and gardening. So it really is kind of a nice general measure of, active walking, stepping, doing any kind of thing. And then heavy exercise is what it sounds like, heavy. And then also there's smoking. Okay. And so these are fairly limited measures. And so but unfortunately what we need is that along with measures of income, because we're trying to use that to think about, okay, what is the connection between the effort you're exerting and your income? And then we also use that to think about, what is your health status today, what is your effort today, and what is your health status tomorrow?
You mentioned that the paper constructs a dynamic model of health insurance to evaluate the short and long-run effects of policies that prevent firms from conditioning wages on health conditions of their workers, and that prevent health insurance companies from charging individuals with adverse health conditions higher insurance premium.
Right.
That's what you're specifically interested in.
Yeah, so we're thinking about that. There are 2 big sort of policy interventions. One where I think we really kind of closely capture it, which is Obamacare. So there they really are doing, pretty much literally what we're suggesting. Then there's the American with Disabilities Act and its amendment, and basically that, the act and the amendment are trying to limit the extent to which employers can discriminate against workers with respect to hiring, firing, promotion, and wages for any kind of health-related issues. Now, the extent to which they're constrained, there are limitations on that. It has to be somehow reasonable expense and reasonable accommodation. But my understanding of that is, that can be reasonably expensive, and and you can have to make a fairly significant accommodation for someone.
So let me step back a bit here and take a look at how you approach this question of evaluating these government interventions. You begin with a model, first of all, that's completely absent of government intervention. You model what you call a competitive insurance market.
Yep.
By construction, this market does not work fully well. It provides some insurance, but there are frictions that prevent a fully idealized situation from occurring. And it's in the context of this model that you evaluate these 2 restrictions.
Yep.
Okay. These restrictions...
Let me say a little bit about what does that is that both the labor contracts and the insurance contracts are short-term, in the sense of, for whatever the period length, that's the length of the contract interval. And so that limits a lot of the insurance. Also, what's true is those contracts are not conditioned on the effort you make to take care of yourself.
And that's an assumption
And that's an assumption.
that you think is a reasonably good approximation of the type of health policies we see out there.
Yes, when we go to the data, we're going to look at a period length as being 6 years.
Okay.
And so then the notion here is that any sort of reasonable amount of labor mobility, people moving across jobs and moving across insurance companies, would probably wipe out that kind of conditioning.
And one property of your model is that after 6 years, the time length that a person is in a pre-existing condition, he has to become reinsured with a pre-existing condition.
Yes, that's right.
That's kind of critical.
That's built in.
Okay. Now, you considered two types of policies. Like I said, the policy of firms preventing that prevent firms from conditioning wages on health conditions.
Yep.
Because in your model, firms do this, I presume. Yep. And secondly, the restriction that prevents health insurance companies from charging individuals with adverse health conditions, I guess the pre-existing conditions, higher premium.
Right.
You study each of these interventions individually.
Yep.
And then jointly.
Yep.
Tell me what happens here.
Okay, so when you look out there, one of the things we were interested in is, where are the big health-related risks that people face? And it turns out the big, chunk of it is actually with respect to income and wages, and it's not medical expenditures. So that's the more important risk that you face. And I think I'm going to throw out a rough number, which is that if you go from the highest health status to the lowest health status, you're looking at something like a 30% drop in income, just in terms of the averages conditioning on health status. So that's a lot of risk. Now, one thing that's true with respect to the medical risk, we're looking at people between the ages of 24 and 60. And so if you think about medical expenditure risk, a lot of that is going to be post-60.
Sure.
So, we are looking at a certain period.
Okay.
I'm just, but conditioning on that, the big risk is earnings risk. And it looks like your health can have a significant impact on, what your life cycle profile of earnings looks like. And in many ways it looks, very reasonable, which is especially for what we have. We look at people's earning profiles, if high school educated or less, and then above high school, and you see a fair amount of sensitivity in both, but it's more pronounced in the high school or less.
So, but let's take one of these policies individually. Pick whichever one you want. You want to evaluate the effect that it has on the population, prime age population, I guess, that you're looking at. And describe to me how the model people behave in terms of their willingness to remain healthy, to do exercise, and how it impinges on their lifetime earnings profile. I presume they're made better off by the policy, individually.
It depends on the relative to the competitive.
Right.
Turns out to be a fairly low benchmark in terms of it in the way that we ended up. So one of the things I guess I found that was surprising when I started thinking about this is I thought, the incentive effects would be, and the incentive costs would be very negative. So when we came at this, the vision we had was the incentive you have in terms of taking care of yourself. It doesn't help you on this week or this month, but over some longer horizon, it's going to affect things. So the time unit here is 6 years, as I said. Mm-hmm. And so the updating of your health status between this period and the next, we thought that you could actually significantly affect with exercise. Sorry, let's say health-related effort. And that's supposed to cover a lot of things, diet, whether you brush your teeth, whether the whole gamut of things that you're supposed to be doing. And so the vision we had was that people do that stuff for a reason, and the reason is to sort of maintain themselves. And people probably have an innate desire to sort of maintain themselves, but there's also, you're responding to the economic incentives. I mean, if we just think about, professional athletes, they're exercising like crazy during the off season so they can show up and still function.
Sure.
So the vision we had was that people were probably going to be reasonably sensitive to this. And then the question comes up, what happens as you put in policies that look very good in the short run, in terms of providing a lot of insurance and filling holes that exist in the market as we saw it, but at the same time remove the future risks that were driving you to take care of yourself, and through that you have this longer run incentive cost. And what we were interested in doing is sort of thinking about if we go about trying to model the policies carefully and think about it and then quantify the trade-off, how much insurance is efficient? And the answer we found, which surprised us, and well, let me say surprised me, was that actually you do want to provide quite a bit of insurance. And so something like, if we think about, we looked at the socially efficient level, you know, given that you face the same incentive problem as the companies in the market, exactly, that you can't control people's effort to maintain themselves, you end up still wanting to provide, you know, a lot of insurance to them. You know, I'm thinking like, you know, say roughly 85% of their health insurance risk.
Wow. So, but and in terms of like, consider one of these programs individually. I guess one question I want to know: are people healthier with this intervention or without it?
They're definitely less healthy.
Less healthy. That's kind of provocative.
Right.
The statement is that this type of intervention actually promotes overall welfare through the insurance effect, but it does have this, seems to have these predictive adverse consequences in how people maintain themselves over their life cycle. I mean,
right. No,
like
first of all, that's completely correct. Now, it is, one could argue, a little bit built in by assumption, and let me explain to you what I mean by that. We're thinking about insuring you against within period health risks. Now, these health risks, the way we model them, the impact of that is it lowers your productivity within the period.
Okay.
And so your health status comes in as a factor that's going to affect your likelihood of getting a negative shock within the period. Okay. And then you go into the next period, you know, and it's only the health status that you have in the next period that's going to affect your productivity. The way we looked at, the way we modeled, and there was a reason for that, which is that the updating of your health status only depends on your effort. And it didn't depend on medical expenditures that were made on you. And the reason why is when we looked at the data, sort of certain things cried out that, you know, if you look at health status, does it affect earnings? Yes. If you look at health status, does it affect medical expenditures? Yes. If we looked at medical expenditures within the period, how does that affect, you know, updating? The effect was extremely weak and, if anything, negative. Now, you might think that, you know, there's a reason why, you know, people are getting those medical expenditures, but at least at a first rough pass, looking at the data, you know, you did not see that, you know, as a first-order piece of business.
Interesting.
So we dropped that in terms of assuming that that was irrelevant to the updating.
So, can I ask a quick question on in the model? How are these programs financed?
Okay, so so the way in which we financed, for example, our version of Obamacare was we simply had actuarially fair insurance that everyone had to pay the common premium. Right. So basically, the program was self-financing.
Okay.
And then when we do the no wage discrimination in the theoretical section, what we looked at was just, you know, compressing everyone to some sort of health, education, age-related average wage. And so then when we go actually at the end, what we consider is assuming that there were some regulatory costs to things. And we don't sort of much see it with respect to Obamacare, though you might argue that, you know, for sure it's going to be there. But we thought any attempt to really force the pattern of, you know, who works for what at what wage, that would have significant costs. So we explored, you know, putting a little bit of costs in. And what we found in general was it's very easy to rationalize putting in Obamacare as a welfare improving program. A little bit of costs make you, you know, on the wage readjustment means that, you know, you don't really like the no wage discrimination policy. You prefer Obamacare. And that comes out as the policy recommendation of the paper. But what you don't want to do is insure people against all of their health-related risks. You want to leave them with some incentives to take care of themselves.
That's interesting. I was going to get to that. You mentioned that you consider the welfare benefits and the incentive effects of each of these programs individually.
Yep.
And you find that individually, that net people would prefer these programs relative to your benchmark.
Yeah, competitive, absolutely.
But that jointly, that's not the case. And what is the reason for that? Is it?
Well, first of all, there's a lot of risks that people face. But one of the things we do, which is kind of cool, is we can follow people and we can ask people, well, how do you feel based on your health status? And how do you feel when you're young based on your health status as opposed to when you're old based on your health status?
When do you ask them?
We could ask them in the model.
Okay.
And so what's kind of cool about that is as you get out there, your health risks are shrinking as you go out because whatever you're going to get, you got. And so, for example, if we got someone, say, our age, and in excellent health, so you look very good, so 30. I'm assuming, yeah, we're ready to, you really are against these programs. You like the competitive program because basically in the program, any version of these programs, you're going to be subsidizing the people with less health risk, and the insurance benefit to you is small because the window left in our setup to get a negative draw is shrinking. Right. And so what you see is, you're kind of very open when young to these insurance programs, and then as you go forward, depending on where you are, your attitudes sort of diverge. If you get a bad outcome, you're very much for the program, and if you get a good outcome, you become increasingly hostile to the program.
That sounds perfectly natural. We change our minds all the time as we age.
Exactly, right? But it does sort of explain some of the voting patterns out there if you think about it that way.
In the joint provision, hypothetically speaking, in your model, if the government was to propose the joint provision of these two programs, I presume that it would be voted down.
Especially if you think that the older people vote more than younger people.
And by older here is still under 60.
Yeah, absolutely. The model doesn't go beyond 60. That's correct.
I see.
So I thought there was an interesting political economy dynamic there.
You mentioned that one thing that surprised you was you found potentially large welfare gains to the provision of these programs. But I noticed one property of your model is simple, basic framework to start with. But one property of your model is that you do not permit people to save.
That's true.
There's no financial market, and that for some purposes that would be an appropriate abstraction. In this case, I wonder how sensitive the welfare effects would be. I mean, people would naturally want to, if they had the ability to build up precautionary savings as a substitute for the missing insurance. Do you have any sense, do you think it might be worthwhile to pursue this investigation along those lines, or do you have some reason to believe it's not important?
I would actually, I think your instinct is exactly right. If I was to say, what's really missing from this model, I think that would probably be, first on the punch list. You're going to know this well. When you write down a model and you try and, construct its implications and try and take it to data, there's a real desire to hold down the number of moving parts and to add moving parts slowly. And the reason is you want to have some idea of what's really going on, what's driving your results, what are the implications of your model. Having savings, I think is, obviously that's like the next Mach 2 thing to do, and I think it's important exactly for the reasons you said. But that we chose deliberately to leave out because what it meant was we could sort of have this the one period or static version of the model, and then when we go to the dynamics, you just have to worry about the dynamic incentive to maintain your health. So you get a nice, simple characterization of how you'd want to do that, and it allows you kind of a nice, clean way to go after the data. And we didn't have to worry about the amount of savings that people had when we thought about effort and updating and all those kinds of things. But it allowed for a lot of transparency, which is a good thing.
Absolutely.
In terms of what we're doing. But I think that's a weakness.
So that's great. So I guess just to wrap up, if you had to summarize the results of the paper in 2 or 3 bullet points, what's the main takeaway of this body of research? Maybe not even just this paper, but where you expect this methodology to help us and guide policymakers in the future.
Okay, so there are a couple of things that I thought that were very informative. In writing down an explicit model like that, you saw exactly where the frictions were that drove the regulation in various ways, and in particular the need to try and regulate the form of the insurance policy and to mandate participation. So that's one thing you got out of it. Second, I thought thinking seriously about the ability of people to control their health and the impact of their health on both their income and their expenditures, that seems like an important component of thinking about, what we should be trying to get people to do, whether we should have programs to try and, push more of that effort on their part, and what are the cost benefits of insurance. And trying to think about how to take a model like this to the data in some aggregative sense, I thought was a big challenge. Mm-hmm. And so if I was going to tell you one part I thought that was kind of interesting, and would like to try and find more medical studies like this, which is they looked at people and the incidence of hypertension, and they again had these self-reported health status levels, and then we know about the incidence of hypertension by health status level. And we could look at, how much the high exercise group that they had in the experiment versus the low exercise group experienced, had a difference in the level of hypertension. We can replicate that experiment in our model. Mm-hmm. And what was kind of cool about it was, the numbers lined up pretty well. I'd like to see, more, I'd like to be able to try and think more carefully about, or have, maybe more micro data on the incidence of obesity on income and other factors like that. So the challenge for us would be to try and line it up more tightly, because in the end, the numbers are important.
Very cool, Hal. Thank you so much for taking the time to explain your paper to us.
Oh, it's my pleasure to be here.
Enjoy the rest of the conference. Have a good time in St. Louis.
Will do.
Thanks again.